In this video, I'm going to share with you those investing principles that I wished I had known earlier. After buying my first mutual fund about 40 years ago, I've learned a whole lot about what I wish I had done and what I wish I hadn't done. We can always see 2020 in the rearview mirror, right? So this video is about sort of big picture things, investing principles. Hi, I'm Camille Gaines here and on my website, retirecertain.com. I share what I've learned from my own investing adventure over the last 40 years and also from creating alternative income streams for the past 15 years or so with my husband after we sort of accidentally stumbled into early retirement. If this topic interests you, make sure you subscribe to my channel and click that little bell so you'll know when I post a new video. The very first investing principle that I want to share with you is that once in a lifetime opportunities come along about every decade or so. Looking back, I can see that really clearly, right? And even though once in a lifetime opportunity sounds like it would come along once in a lifetime, well, looking back, they really come along about once a decade, or they have based on my experience. And every decade's different. Every few decades are different. We don't know what's going to happen in the future, right? But we can sort of look to the past to have a good idea and to learn lessons about how to invest and how to move forward. So let me give you an example of this. I bought a condo in Houston when I was working and I was in my mid-20s. I saved up and made the down payment and I just wanted to own my own home. So I bought a condo and I paid around $60,000 for it at the time. Now I ended up getting married, moving overseas, long story, but I ended up keeping my condo and it became my first rental property not that long after I bought it. So I paid around $60,000 for it. I leased it for a number of years, but what I really want to show you in this example is the opportunity in hindsight that presented in this itself around these condominiums, okay? And this is in a nice area of Houston near the Galleria, you know, the location rule, right? So these condominiums, I paid around $60,000, and years later, about a decade later, we were back in Houston and we saw that these condominiums were selling for $30,000, and they were leasing for over $400. So that would have obviously been an excellent investment. Now, granted, with condos, you have homeowners associations and etc. There are a lot of variables, but this was clearly an incredible opportunity. And I seriously considered it. I knew it was a great opportunity. I wanted to buy the condos. There were several for sale. The market was just really a buyer's market. I love those buyer's markets when we have the money available to act. So in this situation, though, I had two young kids. I lived overseas. It would have been hard for me to manage the condos, so I didn't buy them. But guess what happened? Only a few years later, those condominiums had risen in value to just right under $100,000. And the opportunity would have been there not only to have the income they would have paid for themselves, but also there would have been an opportunity to build wealth and sell those condominiums. So that's a perfect example of looking back and seeing how cyclical things can be. And when we only focus on asset allocation, like, oh, I've got to have, 40% in bonds or 20% in bonds and, 60% in stocks or 80% in stocks or whatever your asset allocation is. And when we only focus on that and we're really into the whole asset allocation thing in stocks and bonds only, we miss opportunities. Now, that's not to say there aren't incredible opportunities in stocks and bonds as well. Let me give you an example of this. I invested through the 1990s, and everyone said at the end of the 1990s, there's going to be lower returns over the next decade. Please don't everybody expect what's happened over this last decade to happen over the next decade. You can't plan on it. Oh, but they were absolutely right. It makes sense, right? Stocks were very, very overvalued. So the Nasdaq during the early 2000s tech bust, it was 2001, sort of 2002, early 2003, around that time frame. The Nasdaq, which holds the technology stocks, dropped 78%. 78%. So once in a lifetime opportunity was after that drop. Quality companies were selling for so much less than they had sold only a short while prior. Then what happened is the Nasdaq stocks made their way back up. In late 2007, they got back up to where they had been prior to that 78% drop. But then what happened? They got a little bit over it for a very, very short while, only a few weeks, and they dropped back down again. They didn't get back to those higher levels, pre-bust and 2007-ish levels, until late 2010. So opportunities presented themselves all along the way there. Actually, two huge opportunities, I guess, presented themselves. March 2009, the S&P 500 that we all have grown to love dearly, it dropped around 55%. And March 2009, I should say, it had dropped 55% from just a couple of years earlier, presenting an incredible opportunity, a once-in-a-lifetime opportunity that comes along once in a decade. All right, let me tell you about investing principle number 2 that I want to share with you. That's to have a wealth plan, an overall plan. It's easy to get caught up in the day-to-day, going to work, taking care of a family, saving for a home, whatever it is that you're doing. And that happens in every decade, whether it's in the 20s, 30s, 40s, 50s, or 60s. We all have these other important things. And creating wealth is put aside. It's put on the side burner. While we're working on it and we're doing it, we don't really have a focus on it or a clear plan for it oftentimes. We're not thinking long term. But when we do that, we can be going in the direction that we want to go. So as young as possible, think about what it is you really want, about what kind of lifestyle you want, about when you want to retire, about where you think you'll want to live. And yes, this absolutely changes over the years. I can certainly attest to that. But when you have a general direction that you're moving and you sort of know, it opens your mind to opportunities. It allows you to see the progress that you're making and to tweak your wealth plan along the way and do things that you need to do in order to reach those goals that are so important to you. Not only that, it really encourages you to do prioritized spending, I like to call it, more so than a budget. You prioritize spending based on your life goals, and that promotes you saving money and investing it all along the way. And when you do that, you end up buying, sure, at market highs when you're investing systematically, every month, every quarter. But it also allows you to buy into markets near the lows. And so you sort of average in naturally, and that helps you avoid just buying near those market highs, which is really detrimental to individual investors, all investors really. Number 3 that I want to share with you, investing principle number 3. Consider investing in assets other than just stocks and bonds. Let me give you an example. Real estate can be purchased in your 20s, 30s, or 40s, and even financed over 15, 20, 30 years so that it pays for itself. When the deal is right and the financing is properly structured, that property can pay for itself completely. And then when you're ready to retire, or in your 60s, or earlier, whenever you want, really, depending on how early you get started, those rental properties can bring in really good cash flow to supplement Social Security income or any other income streams that you might have. Plus, the properties tend to increase in value over the years when bought right. The fourth core investing principle I want to share with you is to buy assets that go up or at least stay even when other assets are going down. So many investors are heavily invested in the stock market now because bond yields are so incredibly low. Some of the clients that I've worked with in my coaching, they've been sort of pushed to overinvest in stocks beyond what feels safe or what seems safe because they don't have enough in assets that will hold their ground or even go up when stocks go down. This tends to happen near the end of bull markets or when other alternatives just aren't there, and that's certainly the case now. And while it does bring some validity to overvalued markets and the markets continuing to go up and to being invested heavily in stocks, there is that risk as well. So we always want to diversify into assets that will hold their ground, if not go up, when stocks go down. And that's not only bonds. Other assets hold their ground as well when the stock market has a serious bear market, like we saw in the 2000s decade, not so much in the 2010-2020 decade. Investing principle number 5 is simply to invest. It feels like when we have money tucked away in a money market that we're safe, right? It feels like that's the safest thing for us to do sometimes. And while, building up cash absolutely makes sense and it's hard to find investments that you want to make that make sense at the valuations, if we don't invest for too long, then we end up losing out to inflation because that money is depleted every year by inflation, and also something called opportunity cost, which just means that we're not taking advantage of investments. We're not growing our money. We're not building our wealth. That money is actually losing value as it sits in the money market because it's being depleted by inflation and along with the opportunity costs that it's missing. So invest your money. But first, know how to invest your money. Don't just throw it in. Invest wisely. Investing principle number 6 is don't think that what's happened recently is necessarily going to happen over the next few years, okay? And when I say recently, I mean the past few years or the past decade, right? Been there and done that. It is so easy to get caught up in thinking that what has happened is going to keep happening. It's called recency bias. It actually has an official name in behavioral finance. It's so real because we all can easily get caught up in that. We can think the stock market is going to go up 10% a year or 13% a year for the next decade. And we start planning around that and we think that's going to happen. Or we think that interest rates are going to be a certain way than like they've been recently, like they've been low recently. So we think that they will continue to be low. But if you look back over decades and what's happened historically, decade, not just one decade even, but several decades, you'll see that there are patterns and trends and cycles in the markets. And while the markets are always a little different when we go through corrections, there are all these commonalities as well that we can learn from and we can use to be smart investors. But the main thing is just don't get caught up in that recency bias and think that's what has happened lately is going to happen over the next decade. It allows you to avoid market tops. It allows you to plan better. It allows you to plan safely, because if you look at the past decade and see that, for example, the stock market has risen over 12%, 13%, and you project that going forward in your planning, then the market doesn't hold up to that standard, then you can see how that could be devastating for someone that's retired and doesn't have enough money, and they discover this when they're 80 years old, right? So look forward and don't think that what's just happened is necessarily going to keep happening. The seventh core investing principle is to appreciate the value of compounding. When your wealth can passively compound and grow while you're doing other things, whether you're working or whatever it is you're doing, then that's magical. It's passive accumulation of wealth. That's why it's so smart to begin as early as you can saving money. And even if you're in your 50s, you can still compound wealth. And that's part of the reason I really don't like planning for retirement withdrawals, because it removes the compounding of wealth. I like other strategies that allow us to generate income instead of having to withdraw 3 or 4% a year to live, because that compounding is given up. And I think as you get older, you should continue to build wealth, not deplete your wealth after you retire. So remember the magic of compounding and let as much money as you can compound passively over the years. If you can add in tax-free, that's even better.